Welcome to the Metro Blue Capital Podcast, the real estate investing education domain. Tune in for interviews and discussions with successful real estate investors and entrepreneurs. They share their knowledge, experience, and key advice on how to build cash flow from real estate and achieve financial freedom. Let's get started.
Hi, thanks for tuning into today's podcast. I'd like to introduce today's guest, Yonah Weiss, Business Director of Madison Specs, Cost Segregation, and LinkedIn expert, and has assisted clients in saving tens of millions of dollars in cost segregation tax savings. Real estate consultant and teacher. Yonah, thanks so much for joining today.
It's my pleasure, Eric. Thank you for having me on.
Yeah, no problem. Thanks. How are you doing?
I'm doing wonderfully. Thank God. Doing
good
today.
Great. So one of the reasons our investors want to invest in real estate are the tax advantages. And I was wondering if you could explain some of the benefits of cost segregation and how it's beneficial to multifamily investors.
Sure. The biggest tax benefit for real estate investors is, depreciation, which is a tax deduction that you get basically for when you buy a property. You're allowed to write off the entire value of that property. It's like a tax write-off. You buy real estate, like government says, hey, now you can write off the entire amount, but you can't do it all at once. So that's really what depreciation is. It's still an incredible tax benefit, a tax deduction, but you're only able to take it over a longer period of time. Being a real estate professional, and I know this is maybe news to a lot of people, is really the number one thing that you have to look at when looking at the real estate, the tax benefits for real estate investing is if you're actually a real estate professional. And there's two things that come along with that. Number one, if you're a real estate professional, and this is an IRS tax definition, okay? So if you spend the majority of your time in the real estate trader business, so you own properties, you're brokering, you're managing, operating, buying, et cetera, constructing, doing renovations, you are considered a real estate professional. That means you can literally take tax deductions like depreciation to offset all of your income, any of your income, not just income from properties, but income from any of your non-passive income as well, active income, etc. Why is that important? Because depreciation is awesome. Okay, depreciation is the best tax deduction probably any real estate investor has. However, it's limited, generally speaking. If you're not a real estate professional, it's limited to how much of it you can actually benefit from. So usually it's just used to offset your normal income from your properties. So let's say you make, $10,000 from your property, and you have $10,000 depreciation deduction. That's great. It wipes that off. You pay zero tax on that real estate income. But if you have $100,000 of deductions, okay, from depreciation and only $10,000 of income, then that extra $90,000 of tax deductions, which can be created with cost segregation, you can't use it. It doesn't get lost, but it gets carried forward and you can't use it this year unless you're a real estate professional. If you're a real estate professional, you can literally use that to offset any of your other active income as well. So that's really in a nutshell why real estate is so awesome, why real estate investment has such great tax benefits, and specifically from this the real estate professional status.
That is awesome. Yeah, no, definitely. Very, very interesting. Well, could we know a little bit more about your background and how you got started with cost segregation?
Sure. I am, work for the largest national cost segregation company, Madison Specs. So we work in all 50 states. I kind of got involved in real estate about 5 years ago. Really wanted to learn everything there was to know about real estate. I'm a teacher by, my background is in teaching and, studying it's really my passion. So finding kind of a new career or a new endeavor, which was for me, real estate, was just fascinating because there's so much to it. And I just soaked it all up, learning commercial real estate, the mortgage side of the business, the financing side of the business, the brokering side of the business, the actual fix and flips, like doing actual deals. And, I just was so fascinated and loved it and just wanted to learn more and more. So that's kind of how I got involved with this company, Madison, that I work for as someone who's consulting people in real estate, and I take the expertise of, the people in the firm who have been doing it for decades and really are the experts in the industry in this subject, and took my teaching skills and kind of brought this kind of strange, mysterious concept of cost segregation and try to simplify it for the masses.
Interesting. That's awesome. Yeah. Well, let me ask you, so when you're purchasing a property, or the depreciation is about 27 and a half years, if I'm not mistaken, how does that work with cost segregation? But if you can explain or give an example in a nutshell, like how that would work when acquiring a multifamily.
Sure. So let's say you buy a multifamily, and you can do the simple math from this, but let's say you buy a building for $1 million, and you can multiply this by however many millions of dollars that multifamily property is. But $1 million, the first thing you do is you have to subtract a certain amount for land. Land does not depreciate. So, let's say just for all intents and purposes, 20%. Okay. So you're left over with what's called $800,000 of basis. That's your tax basis. That's the amount that you can now write off. So like you said, over a 27-year period, 27 and a half years, that means you take that $800,000, divide it by 27 and a half, and you're left with approximately $30,000 a year of tax deduction. So and that's because we're lumping the entire sum into one category on a 27 and a half year schedule. Comes cost segregation and says you can actually break down the building. You can segregate the cost. Okay. You can take that cost, $1 million, $800,000 of basis, and you can split it up into different components, basically split the building into different components that depreciate on different schedules. So there's certain things that depreciate on a 5-year schedule. There's certain things depreciated on a 7 or 15-year schedule. By having an engineer, a cost segregation engineer, come to the property, identify what all of those details are. So you have, personal property, which can be anything like, appliances or furnishings, equipment, carpeting, wall coverings, cabinets, anything that's in the building, not part of the structure, depreciates on a 5-year schedule.
Okay.
So once you establish what those things are, what the value of those things are, you can actually take that value, let's say 20%, and now you can take that as a tax deduction the first 5 years.
Very interesting. 5 years.
Yeah. So your $1 million, right? Instead of $30,000 deduction every year, you now will have in the first 5 years, something more like, close to $80,000 of tax deductions.
Okay. Interesting. Yeah. Well, let me ask you, the process of cost segregation, when should it be started, or you hire someone to do that? Would it be after, before rehab, after you've acquired a multifamily, before capital improvements have been made, before or after? Like, when is the ideal time to do cost seg?
So you should do it immediately after acquiring a building. It is the best time to do it. However, you can do it really anytime thereafter. And there's really 2 stages. There's the acquisition cost. Okay. So that whatever money you spend on a building, that's what's depreciated. So you have the acquisition cost. So you can do that right away. You don't have to, because like I said, you can do it, anytime thereafter. But a lot of people like to do it immediately so that they can reap those benefits in the first year, tax savings in the first year. However, when you do renovations, you're adding more money into the property. That money that's added into the property now can also be deducted. So you can take the tax deductions from that also, that gets depreciated. So you can actually, after doing a major renovation, that money spent can now be segregated as well, meaning you can split that up into the faster lives and take those tax deductions as well.
Awesome. So just right from the get-go. Yeah.
Right from the get-go, and then you can do it again. Like I said, anytime you're doing renovations.
Okay. Awesome. So let me ask you, can the overage of cost segregation depreciation be used to offset tax liabilities on other types of income or income producing assets? I think you kind of discussed that a little earlier in the conversation. Right. Like, if you can give an example.
Sure.
If you have an overage of savings.
Yeah, like I mentioned at the very beginning, the real estate professional status allows you to really take those deductions and use them to offset anything. So that's really where the biggest bang for your buck is going to be. However, generally speaking, depreciation is considered a passive deduction, only to be used to offset your passive income. So that can apply to any other property that you own. Okay. Mm-hmm. The depreciation from one property can be used to offset income from all your other properties. Mm-hmm. However, besides for that, there's not much else that fits into that passive income category, except for, I think royalties is considered passive in that regard, or certain passive business investments. Stocks is not considered passive income for that regard. But yeah, so you can use that not only to offset income from other properties, but if you're a real estate professional, now you can go ahead and use that to offset any of your active income as well.
So if someone had like a retail store or business that's kind of in a way passive because they're, they have employees that are working there, would that be something that it would roll over to that type of asset, or no, as a business?
No, that's an active business. Only if you would have like a passive business. Let's say you invested in someone else's business, and as a partner, a silent partner, something like that.
Like an LP, yeah. Well, what are some examples of what can and can't be depreciated? For example, like a roof or carpet. You discussed that a little bit earlier.
Sure. Yeah, it's basically anything that's structural, that is integral for the building, depreciates on a 27.5-year schedule. Anything else can really be broken out from that, figuratively speaking, broken out and be depreciated on a faster level. So the main two categories are, like I said, the personal property, and then there's something called land improvements. So personal property really is anything that's not structural. So like I said, anything like the carpeting, the fixtures, furnishings, appliances, even stuff like special purpose lighting or millwork, window treatments, things that are in the building, again, not structural. Structural things are like the roof, doors, windows, floor, not flooring, because the flooring is not attached, even though it's attached, but it can be removed. It's not integral to the structure. Everything else can basically be put in that. So the other category, the land improvements, which is another huge one, can be anything that's outside your property. So pavement, okay, if you have a parking lot, all that pavement, the landscaping, the fencing, signage, everything out there depreciates on a fast 15-year schedule.
Awesome. Well, how does cost segregation depreciation differ from like industrial, commercial, retail, as opposed to residential real estate like multifamily?
Well, first and foremost, all other type of commercial properties besides for multifamily depreciate on a 39-year schedule, which means you're going to take that purchase price, that basis after land, and split it up over a 39-year schedule. So on the one hand, you have less benefit because you're taking less amount each year. On the other hand, with cost segregation, you're actually having more benefit because you can front load a whole lot more and into a much faster schedule. So from 39 to 5 is much better than from 27 to 5, because obviously you're getting those tax deductions relatively quicker. There are certain types of commercial properties that will have more benefit. Again, it's a percentage. So I mentioned, 20% of the multifamily building, that's pretty average. In certain types of, heavy industrial or, office buildings may have, upwards of 25, 30, 40% of reclassification of assets. So there are certain, each property is different and unique in that sense, because, it's not just like throwing a dart at the wall. The engineer actually has to come to the property. There's a real assessment. There's a real, measurements and pictures and a whole 9 yards of, how they come up with those numbers.
Okay, awesome. It's very interesting. Well, let me ask you in general, like property owner, how are they charged for the fee of hiring a cost seg specialist? Like if it's a flat fee or a percentage, a contingency fee based on the percentages saved, the tax, saved, like how do they get paid?
It's definitely not contingent. I mean, I've heard that there are some firms out there charging a contingency fee, which is not so kosher, because you're no longer like a third party consultant. You're basically telling the IRS, I'm taking a piece of this, so give them this, this amount of deductions, and I'm going to take a piece of it. So yeah, it's a one-time flat fee based on the scope of work involved. There's, typically speaking, it's pretty insignificant compared to the actual tax savings. So for multifamily properties, as of 2020, Madison Specs, and I can only speak for ourselves, other firms are charging, different amounts maybe, but, typically between $4,000 to $6,000 is going to be like the flat fee. And so if you have $1 million building, you're looking at, the minimum $100,000 of tax benefit. And for each $1 million, that just multiplies. So if you have a $10 million building, you're looking at easily $1 million, to $2 million tax benefit. The fee is going to be the same, from that $1 million to $10 million property. So it's pretty much a no-brainer at that point.
Definitely no brainer. Yeah. I mean, very beneficial. It's a minute expense compared to what you save, But let me ask you about bonus appreciation.
Yeah.
And are there other types of appreciation, depreciation that?
Yeah, bonus depreciation is a new law that actually came about to be a couple of years ago, which says that any property that depreciates on a faster schedule than 20 years. So essentially that's everything that we're identifying with the cost segregation study. So all of that property, you can now, instead of front loading it to, a 5-year, 15-year schedule, you can take the entire amount in year number one. So that's what bonus depreciation says. So you can literally, in our example, $1 million property, and you're finding a 20% of that, a $200,000 tax deduction.
Mm-hmm.
Instead of spreading that out and taking, $50,000 to $80,000 a year for the first 5 years, you can literally take the entire amount in year number one. So the $200,000 tax deduction in year number one, that's what 100% bonus depreciation is in very simple form.
Awesome. Well, for example, a passive investor, limited partner, that how do they benefit from the tax, or how do they benefit from the cost seg? Just kind of curious in general. And are there any particular requirements or anything to do cost segregation or?
Yeah, anyone who's owning a commercial property and you're investing in it. Okay, you're a limited partner. You have a percentage usually, and this really does depend on the the structure of the operating agreements. In every structure, every partnership is different, but in general, let's take a very simple form of it that a lot of people use, which is that you have investors that are coming in and they're owning shares. They're owning a certain percentage of equity in the deal based on the capital they put in. Okay. And it's an LLC. So everyone has it kind of flows through. The LLC owns the property, and everyone, according to their ownership, gets the, their benefits. So according to your percentage of ownership, you're going to get your income from that property, and you're going to get your expenses. Okay. So you're going to take part in both. And so depreciation is that expense. So let's say you invested $100,000 passively in a deal. That's going to give you a 8% preferred return. Okay. Pretty typical, pretty standard. Obviously there's more, there's less, there's everything in between. That $100,000 producing you $8,000 of income. Okay. In the first year. That $8,000 typically in any other type of investment vehicle out there, that income is going to be taxed, and probably taxed at a high tax rate. With cost segregation, if you are a limited partner, you're going to get your percentage of depreciation on your K-1 tax form, which is going to, in most cases, produce more deductions than you have income. Okay, so you may have had an $8,000 income, but you may have a $10,000 or $20,000 depreciation deduction. That means, it simply translates that you have now made $8,000 and pay zero tax on it. Okay, so that's really important for passive investors to note, that there is basically no other investment vehicle out there that you can have this upfront tax benefit. Yes, you're only going to be limited, unless you're a real estate professional, to those benefits there from your properties. Nevertheless, it's still a pretty good deal.
Yeah, it is, definitely. And any, like an LP, any overage that they would have, like let's say, for example, $8,000 income, but they have $20,000 tax benefits. So
yeah,
if they have other businesses, passive businesses, they could roll that into the income as well. Or
like I said, yeah, if they had extra, correct. If they had extra, either if they had other properties or other passive investments, then yes, they could use the overage, the extra deductions at that point to offset that income. If they don't, it would just get carried forward. So you don't lose it, you don't lose out on it. It goes carry forward means that it stays with you into like an imaginary bank account that you can use next year on your taxes.
Yeah, that is so beneficial. Are there any type of negatives, like at the back end, once disposing of the property, retroactive taxes that need to be paid or anything like that after cost seg?
Yeah, absolutely.
How does that work?
Sure. So it's important to note, when you sell a property, you have something called depreciation recapture tax. So that means that you actually now have to pay a tax on the amount of depreciation that was taken, which can't be that fun necessarily, but with the right tax strategy and the right planning, you can actually, mitigate that by other ways of reducing that tax on the back end. But generally speaking, it's a 25% tax. So the benefit of, the tax savings that you have during the years that you're holding the property, usually outweigh the tax that you're going to spend later on. So for example, if you were to pay the tax now, today, you would never see that money in the first place, right? Versus having to, benefit from not paying tax during these years, having the time value of money, and then later on worrying about if I have to pay tax on it or not.
And I mean, it's a long-term investment most of the time, 5 to 10 years or so. So
Right.
It's not something you get out first or second year. Are there any exciting stories of substantial savings that you've had with previous clients? Like any just examples of crazy savings they've incurred?
Yeah, I mean, there is tremendous amounts of saving. Everyone has tremendous amount of savings, but I'll just tell you one because this is pretty unique. There aren't many types of properties that can have this massive amount of value, but there's we did a cost seg for an RV park last year. Okay, and an RV park, similar to a golf course or a mobile home park, they have very little. When you buy that park, essentially all you're buying is the land and the concrete that sits on top of the land, because there was almost nothing else that actually belonged to the owner. Okay, there were some electrical hookups, there was some septic tanks, and I think there was like a one little 3,000 square foot laundry room or whatever, right? So what they bought was, again, the land and the land improvements. Okay, and if you recall, the land improvements depreciates on a 15-year schedule, which means that's cost segregatable and can benefit from the bonus depreciation. So these guys literally bought a building for about $2.5 million. Okay, and not a building, they bought this RV park. Okay, which people drive up and they rent the space to RVs, and all they owned was the land and the concrete. That concrete was the majority of what they bought. In this place in the middle of Texas, literally had the land value was almost nothing. It was like less than 0.1%. Whereas, usually you're dealing with 10, 20% land. This was like a tiny, tiny little bit of land value. So they ended up taking, because of bonus depreciation, over a $2 million tax deduction in the first year, because they had over an 80% reallocation. I think it was like 87% reallocation due to the cost segregation into that 15-year category. So again, $2.5 million purchase price and over $2 million first year tax deduction. That was pretty crazy.
That's insane. Yeah.
Because again, you're not spending all that money, right? The bank is financing most of it. So the benefit of depreciation is that you get to take depreciation on the entire purchase price, not the amount that you actually pay out of pocket. So these guys literally put down, and with investors and all together, put down maybe, $400,000, and then the first year getting a $2 million tax deduction on that $400,000 investment. It's pretty cool.
Yeah, it definitely is. Well, that pretty much wraps it up for today. And if you guys have any questions or would like to reach out to Yonah, he can be reached via LinkedIn or at his website, www.yonahweiss.com. The link will be in the description. Yonah, thank you so much for your time. I really appreciate you being on today's podcast. If you like this video, please subscribe below and visit my website, www.metrobluecapital.com. Thanks so much.
Thank you for listening to today's Metro Blue Capital's podcast. For more information, please visit metrobluecapital.com.